statement due date versus payment due date. What's the difference and how can you navigate them to make sure you're using your credit card properly and boost your credit score as much as possible in 2023? Let's get into it. So if you're watching this video, I assume that you're pretty new to credit. So let's first talk about what a balance is on a credit card and how that works. A credit card can be looked at as a short-term loan. If you spend $100 today, you're using the bank's money with the assumption that you'll pay it back at a later date. The likelihood that you'll successfully pay that balance back is reflected in your credit score. The higher your credit score, the more likely you are to pay that balance back, hopefully in full. And that ties us back to the payment due date. The payment due date is the date upon which you have to pay at least the minimum payment to avoid late payment charges and other fees that may be tacked on by your credit card company. Now, paying the minimum is fine. You're going to be avoiding those late fees and charges, but you're going to be owing a lot more money in interest rate over the long term. Let's say your credit card has a balance of $5,000 and you have an interest rate, an APR, of 16%. Let's also assume that the minimum payment required is $100. If you only pay down the minimum, it will take you almost 7 years to pay down this entire balance, and the amount you owe in interest will be $3,294, which is almost as much as the original balance was to begin with. So in total, you're going to be paying over $8,000 for a purchase that was only $5,000. So that's why you shouldn't be paying the minimum, because interest rates on credit cards tend to be much higher than any other bank product out there. For example, my Chase Sapphire Reserve has a 24.24% interest rate. And the thing that's scary about interest rates on credit cards is that it compounds daily. So the amount of interest that you owe can escalate very fast. This can get very dangerous too when you add in other factors like Afterpay or Klarna, which you're dividing up payments even smaller chunks. So it makes it feel like you're not paying as much money, but again, you're owing interest and padding that payment out over a longer timetable. So the payment due date, in sum, is the day upon which you have to make at least the minimum payment to avoid those extra fees. But again, you should be paying more, or ideally your balance in full, so that way you're not owing a lot more in interest down the line. Let's talk about statement date. The statement date is the last day of your billing cycle. It usually occurs 21 to 25 days after your due date, and it's the period upon which your interest rate is going to be calculated. Your minimum payments will also be calculated based on that previous month's charges on the account. Now, one thing that's important about the statement date is the date is going to record your credit card utilization and report that to the major 3 credit bureaus. Utilization is the ratio of your total credit limit divided by the amount that you spent that month. So if you have a credit card limit of $10,000 and you spend $1,000 on the statement date, your card utilization will be 10%. Ideally, that number would be 0. So oftentimes I like to pay my balance down in full before the statement date so that when it's reported to the credit bureaus, my utilization is low or 0 in many cases. Now, the gap in time between the statement date and the payment date are considered grace periods by certain credit card companies, but this isn't the case across the board. In fact, some card lineups, such as the Amex Gold or Amex Platinum, are charge cards, meaning you have to pay your entire balance down in full every single month, unlike a normal credit card, which can allow you to roll balances over. So let's go ahead and quickly recap just to make sure everyone knows the difference. Payment due date is the day upon which you have to make at least the minimum payment, or you're going to owe those extra fees on top of it. And the statement closing date, the statement date, is going to be the day which your information on the remaining balance is going to be reported to the credit card bureaus. Now, how I like to do it is I like to set up auto pay to pay down before the statement closing date. So that way my credit card utilization is going to be 0 or as close to 0 as I can get it before that due date comes up. So when it's reported to the credit card companies, my utilization is almost 0. If you keep it below 30%, you will maintain your credit score. But if you go over 30%, you are seen as a more risky borrower, which can definitely hurt your credit score in the long run. When I got the Chase Freedom Unlimited, I made a large purchase to hit the welcome bonus, but I didn't factor in my credit limit, and I actually was over that utilization ratio for that first statement date. I paid it down in full immediately after I caught it, but it was too late and was reported as overutilization, and my credit score dipped about 50 points. So I don't want that to happen to you guys. Just keep in mind your overall credit limit and how much you've spent on your card in that billing cycle, and try and get that ratio of the billing, payment overages versus the total balance less than 10% or close to 0 as you can get it every single month. Hopefully I did a pretty good explanation. If you still have questions, please comment them down below. I'll also leave the links to the articles I was referencing as the information because I don't want to steer you guys in the wrong direction. Set up auto pay and keep on top of your balances. And if you can't pay off your balance in full every single month, try to pay more than the minimum payment. Simply adding $50 more than the minimum payment can drastically cut down the amount of time and the amount of interest that you will owe in the long run. Now, there's other options you can look into, such as 0% financing or balance transfers, but that can get very complicated very fast, especially if you are irresponsible and keep spending more on top of what you already owe. We can make another video in the future about how that works and different strategies to pay down debt the most effectively, but the best thing to do right now is to just make sure you're paying that balance down in full every single month before the statement closing date, so that way when it's reported, that interest rate utilization is 0%. Like always, thank you guys so much for watching. I hope you found this video informative, and if you did, please leave a like and share it with a friend who might also benefit from the information in this video. Catch you guys in the next one.